Hi, everybody, and welcome back to video number 6 in chapter 17. And when we left off, we were looking here at the journal entry for March 31, 2025, where we had the two expected units that would be returned, and we penned that journal entry. And then finally, to record the expected return of the two video games and the related reduction in cost, we would reflect a debit to estimated inventory returns and a credit to cost of goods sold for the $40 of cost. The refund liability account is the amount Epic is expected to return to GoGamer. The refund liability account is updated each reporting period for the changes in circumstances and is reported as a liability on Epic's balance sheet. The estimated inventory returns account will generally be added to the returned inventory account at the end of the reporting period. All right, for solution for part Bravo, let's go back. Here, how would the information be reported on Epic's income statement and balance sheet related to March 2025? And here, we would have sales revenue for the 100 units at $50, $5,000, less sales returns and allowances. That would be the 200 plus the $100 or $300. So the net sales would be netted at $4,700. Cost of goods sold would be the $2,000, but less the cost of the $200 and the $100 here. So our gross profit would be $2,820. And as a result, at the end of the reporting period, the net sales reflects the amount that Epic expects to be entitled to collect. Epic reports the following information on the balance sheet as follows then. Its accounts receivable net is going to be $4,800. And the returned inventory included that which was estimated is going to be 6 units times $20 here. And the refund liability is going to be 2 units times $50 or $100. Okay, repurchase agreements. This allows a company to transfer an asset to a customer but have an unconditional forward obligation or unconditional right, called a call option, to repurchase the asset at a later date. If the obligation or right to repurchase is for an amount greater than or equal to the selling price, then the transaction is a financing transaction. So here, if the customer does not obtain control of the asset and the asset is repurchased for more than the selling price, if that is yes, it's a financing agreement. If no, it's a leasing agreement. Okay, these repurchase agreements are sometimes called a forward or call option. So let's look at an example. Morgan Incorporated, an equipment dealer, sells equipment on January 1, 2025 to Lane Company for $100,000. It agrees to repurchase this equipment, an unconditional obligation, from Lane Company on December 31, 2026 for a price of $121,000. Should Morgan record this as a sale for this transaction? And the solution is, for a sale and a repurchase agreement, the terms of the agreement need to be analyzed to determine whether Morgan Incorporated has transferred control to the customer Lane Company. As indicated earlier, control of an asset refers to the ability to direct the use of and obtain substantially all the benefits from the asset. Control also includes the ability to prevent other companies from directing the use of and receiving the benefits from a good or service. In this case, Morgan Incorporated continues to have control of the asset because it's agreed to repurchase the asset at an amount greater than the selling price. Therefore, this agreement is a financing transaction and not a sale. Thus, the asset is not removed from the books of Morgan Incorporated. Now, assuming that an interest rate of 10% is imputed from the agreement, Morgan makes the following entries to record this agreement. Morgan Incorporated records the financing on January 1, 2025 as follows. It's going to reflect the fact that it's collected that cash for $100,000, and it has a liability to Lane Company for $100,000. It will do that. Then at the end of the year, it's going to reflect interest expense, 10% of $100,000 here, and we will add to the liability of the Lane Company by $10,000. Morgan records interest and retirement of its liability to Lane Company as follows. Here, on December 31, 2026, it's 10% of $110,000 or $11,000 interest expense. And then finally, the liability to Lane Company is going to be zeroed out, and we're going to pay cash of $121,000. Okay, a repurchase agreement. Bill and hold arrangements. That's a contract under which an entity bills a customer for a product, but the entity retains physical possession of the product until a point in time in the future. So the result, when a buyer is not yet ready to take delivery, but does take title and accepts billing. Okay, an example. Butler Company sells $450,000 with a cost of $280,000 of fireplaces on March 1 to a local coffee shop, Baristo, which is planning to expand its locations around the city. Under the agreement, Baristo asks Butler to hold these fireplaces in its warehouse until the new coffee shops that will house the fireplaces are ready. Title passes to Baristo at the time the agreement is signed. When should Butler recognize the revenue from this bill and hold arrangement? Well, when to recognize the revenue in a bill and hold arrangement depends on the circumstances. Butler determines when it satisfies its performance obligation to transfer a product by evaluating when Baristo obtains control of that product. For Baristo to have obtained control of the product in a bill and hold arrangement, it must meet all of the conditions for change in control plus all of the following criteria. Alpha. The reason for the bill and hold arrangement must be substantive. Bravo. The product must be identified separately as belonging to Baristo. Charlie. The product currently must be ready for physical transfer to Baristo. And Delta. Butler cannot have the ability to use the product or direct it to another customer. In this case, assuming that the above criteria were met in the contract, revenue recognition should be permitted at the time the contract is signed. Butler has transferred control to Baristo. That is, Butler has the right to payment for the fireplaces and legal title has transferred. Butler makes the following entries to record its bill and hold sale, and related cost of goods sold. Pretty standard journal entries there. Debit accounts receivable, credit sales revenue for $450,000. Debit cost of goods sold, credit inventory for $280,000. All right, a principal and agent relationships. Agent's performance obligation is to arrange for principal to provide goods and services to a customer. Examples: preferred travel company, the agent, facilitates booking of a cruise for Regency Cruise Company, the principal. And 2, Priceline, which is the agent, facilitates sales of various services such as car rentals at Hertz, the principal. And then amounts collected on behalf of the principal are not the revenue of the agent. Revenue for the agent is the amount of commission that that agent receives. All right, let's take a look. Flyaway Travel sells airplane tickets for British Airways to various customers. What are the performance obligations in this situation, and how should revenue be recognized for both principal and agent? The principal is British Airways, and the agent is Flyaway Travel. Because British Airways has the performance obligation to provide air transportation to the customer, it is the principal. Flyaway Travel facilitates the sale of the airline ticket to the customer in exchange for a fee or commission. Its performance obligation is to arrange for British Airways to provide air transportation to the customer. Although Flyaway collects the full airfare from the customer, it then remits this amount to British Airways less its commission. Flyaway therefore should not record the full amount of the fare as revenue on its books. To do so overstates revenue. Its revenue is the commission, not the full price. Control of performing the air transportation is with British Airways, not Flyaway Travel. Okay, consignments. Here, consignments, the manufacturer or wholesalers deliver goods but retain title to the goods until they're sold. The consignor, the manufacturer or wholesaler, ships the merchandise to the consignee, the dealer, who is to act as an agent for the consignor in selling the merchandise. The consignor makes a profit on the sale and carries the merchandise as inventory. The consignee makes a commission on the sale. Very simple. Okay, here's Nelba Manufacturing Company ships merchandise costing $36,000 on consignment to Best Value stores. Nelba pays $3,750 of freight cost, and Best Value pays $2,250 for local advertising costs that are reimbursable from Nelba. By the end of the period, Best Value has sold 2/3 of the consigned merchandise for $40,000 cash. Best Value notifies Nelba of the sales, retains a 10% commission, and remits the cash due Nelba. Question: what are the journal entries that the consignor, Nelba in this case, and the consignee, Best Value in this case, make to record this transaction? And I think this is a good place to stop this video. And when we return, we'll take a look at sales on consignment example solution. Until that time, bye for now.